Welcome back to the channel, everyone. If you're new here, this is your go-to place for building wealth, leveling up your financial mindset, and learning how to make your money work for you. Today's video is a full beginner-friendly masterclass, a complete 101 guide on how to start investing. Even if you have no experience, even if you think you don't have enough money, and even if investing feels intimidating or confusing, because here's a truth you might not hear often. Investing is not just for wealthy people. It's for anyone who wants to stop trading time for money and start building wealth automatically. By the end of this video, you'll know exactly what investments exist, where to start, what mistakes to avoid, and how to build a long-term strategy that can grow your money for decades. Before we jump in, don't forget to subscribe, like the video, and tap that notification bell, because we drop high-quality financial content every week, and trust me, you don't want to miss the next one. Alright, let's get started. The first rule of investing, and arguably the most famous rule in the financial world, comes directly from Warren Buffett, one of the greatest investors in history. His rule is simple. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now obviously, no investor gets every decision, right? Not even Buffett himself. So what does this rule really mean? It means you should invest at prices that give you a margin of safety. In other words, don't overpay, don't chase hype, and don't jump into investments you don't understand. Buffett made billions, not by day trading or jumping on trends, but by focusing on undervalued companies, long-term growth, and buying quality at a discount. He let time and compounding do all the heavy lifting. See, long-term investing reduces risk, while short-term speculation increases it. Sure, some people get lucky with short-term bets, but far more people lose money doing that. So if you're starting from scratch, your goal should be preservation first, growth second, and speed last. Before you put a single dollar into the market, you need a plan. Think of this as your investing roadmap. Ask yourself, what are your financial goals? Are you investing for retirement, a down payment on a house, or just general wealth building? Do you want passive, slow, and steady growth, or are you aiming for higher returns with higher risk? Be specific. Create a vision. Once you know where you're going, you can reverse engineer the steps to get there. Your portfolio plan should outline your time frame, your expected return, how much you can invest monthly, what investment types align with your goals, and how much risk you're comfortable taking. This plan becomes your compass when markets get rocky, and trust me, they will. Next, let's talk about paper trading. Think of paper trading as a flight simulator for investors. You get to practice buying, selling, analyzing charts, and tracking gains and losses, all without touching real money. Paper trading platforms allow you to test strategies, learn how markets move, practice emotional control, and get comfortable with volatility. It's risk-free training. Every beginner should start here, because the only thing you can lose is time, and the knowledge you gain is priceless. Now, let's dive into stocks. Buying a stock means you own a small piece of a company. If the company grows, your money grows. But choosing the right company matters. Here's a beginner-friendly strategy that mirrors Buffett's approach. First, research the company. Look at its past performance, profitability, leadership, and long-term consistency. You're looking for companies with a strong track record and real staying power. Second, add it to your watch lists. Don't buy immediately. Wait, stocks move daily, and buying during dips gives you a better price. Third, and this might be the hardest part, control your emotions. Markets go up, markets go down. People panic, and people get greedy. Emotional investing kills portfolios. Panic selling and fear of missing out are traps that make beginners lose money fast. Stick to logic, not feelings. Fourth, avoid penny stocks. Stocks under $5 are tempting because they feel cheap, but they often come with high volatility, little information, and weak business models. Stick to quality. And finally, start small. The beauty of today's investing world is that you don't need thousands of dollars. You can start with $50, $100, or $500. Consistency always beats size. Technology has completely changed the game for beginners. Apps today can automate your investing, round up spare change, and invest it for you, and even help you buy fractional shares. They make investing accessible to anyone with a smartphone. With low fees, easy setup, and educational tools, everything you need is right at your fingertips. Next up are ETFs, or exchange-traded funds. These are a beginner's best friend. They work like baskets of investments. One ETF can include hundreds of companies, giving you instant diversification. They're low cost, simple, and generally lower risk than picking individual stocks. You buy them just like stocks, and they are ideal for long-term investors. If ETFs are beginner-friendly, then index funds are beginner heaven. Think of them as autopilot, mutual funds. They track major market indexes like the S&P 500, which contains 500 of the biggest companies in America. By investing in one index fund, you're investing in Apple, Amazon, Microsoft, Google, and hundreds more, all at once. Index funds have very low fees, require very little effort, and have historically strong long-term returns. They are one of the best investments you can make for building wealth over decades. Target date mutual funds are perfect for people who want everything done for them. You choose a year, for example, 2040N. The fund automatically adjusts your investments based on your retirement timeline. Early on, it's more aggressive. As the year approaches, it becomes more conservative. This is set it and forget it investing at its finest. Then we have robo-advisors. These are automated investment managers powered by algorithms. They build your portfolio, reinvest dividends, adjust your risk profile, and rebalance automatically. They also cost far less than human advisors, with typical fees around 1/4 to 0.5%. You still want to stay informed, but robo-advisors make investing incredibly easy. Finally, if you're a beginner, one of the best places to start is your employer's retirement plan, like a 401k. Why? The employer match. It's free money. For example, if you put in 2% of your salary, your employer might match that 2%. That's an instant 100% return. On top of that, contributions are automated. The money grows tax-advantaged, and compounding boosts your long-term returns. If you don't know your plan's details, visit your HR department. What you learn could change your future. And there you have it, a complete beginner's guide to investing. 10 strategies that can help you start building wealth today, no matter how much money you have. Let me know in the comments. Which investing strategy are you planning to start with? Are you team ETFs, team index funds, or team robo-advisor? I'd love to read your thoughts. If you found this video helpful, give it a thumbs up, share it with a friend, and make sure you subscribe with notifications on so you never miss our future videos. Thank you for watching, and as always, stay smart, stay focused, and keep building your wealth. Until next time.